Hey everyone. Unfortunately, we got some more bad news for EV stock investors as Ford continues to slash prices and update investors, letting them know that sales are falling considerably. But this isn't just bad news for Ford, it's also bad news for Tesla and Rivian stock investors as well, and I'll let you know why that's the case. So in this video, I'll review the latest developments out of these three EV companies, update investors and let you know what this could mean for shareholders, and discuss why this is not good news for EV stock investors. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the bad news came out of Ford on Tuesday, which said that it cut prices on its Mustang Mach-E electric vehicle by up to $8,100. But that wasn't the only bad news. They also updated investors and told them that sales fell sharply in January. Sharply. And this is supposed to be a growth industry, right? Investors are thinking EVs are the next big thing, that consumer adoption is going to switch completely to electric vehicles, and it's only a matter of time. It's only, how fast is it going to grow, right? But that's not the case. Ford saying that not only did sales fall, but they fell sharply. That is going along with what I've been talking about for the last nearly 2 years, that consumer demand for electric vehicles is not strong. It's not strong at all. There's billions, hundreds of billions of incentives from governments worldwide trying to induce consumers to purchase EVs. And despite all those incentives, sales are falling year over year. So why is this the case? Primarily because EVs are more expensive than internal combustion engine cars, and they're less convenient. More expensive and less convenient. That's not a good formula for a growth industry. Sure, you're going to capture some early adopters and sales will explode early as those early adopters purchase these innovative technologies. However, to get wider adoption, your product needs to have some practical, pragmatic sales reasons. And for consumers more broadly, it just doesn't make sense yet. It's still early in terms of the development of this technology. The battery technology needs to get better, charging needs to be faster and more available, and home charging installations needs to get more affordable and more available, especially more broadly in those lower priced apartment buildings where people don't have access to home charging. Charging infrastructure needs to be cheap enough where those owners of those apartment buildings around the world find it attractive to install those charging stations. That's not the case just yet. And so adoption is falling. So now the prices are down 8,100 after sales fall sharply. But that's not the only bad news. Earlier, Tesla cut its prices of some of its Model Y until February 29. They said that this is temporary. Although I wouldn't be surprised if these temporary price cuts turn out to be more permanent. Tesla reduced prices for the Model Y rear-wheel drive and Model Y long range by $1,000, and that represents a discount of about 2.3% and 2% from the previous prices. Of course, if you're following Tesla stock, you'll know that this isn't the first price cut. It's not the second, it's not the third, it's not the fourth. It's now, like, I've lost count, like the 10th price cut from Tesla on all of its models. Across the board, models are getting cut in price because consumer demand is not strong. Prices need to come down in order to increase affordability, in order to increase desirability for these electric vehicles, which I mentioned already are less convenient compared to internal combustion engine vehicles. Now, in 2021, in 2020, 2022, sales were increasing partly because there was severe shortages of internal combustion engine vehicles. There were severe shortages. And so that gave the impression that consumers wanted electric vehicles. But that wasn't the case. Consumers just wanted cars. They wanted cars, and there wasn't internal combustion engine cars available, or those that were available were selling at $10,000, $15,000 above MSRP. I remember I called in to get a quote on a couple of SUVs, and the dealership was quoting me $10,000 above MSRP for a $30,000 SUV. So if you've faced that kind of economic situation and there's an EV available at sticker price or at a regular price, it makes it more attractive to purchase an EV. So that inflated EV sales in 2020, 2021, and 2022. But starting in 2023, supply shortages eased and supply of internal combustion engine vehicles increased. And now that consumers have realistic options where they can go with the internal combustion engine vehicle at close to MSRP, if not even below. I'm starting to see some discounts even for internal combustion engine cars now that supply has increased. It makes EVs a lot less attractive, comparably speaking, when you're comparing with EVs with internal combustion engines. So those factors are also hurting EV sales, to be sure. And even Rivian, which up until this most recent price cut, Rivian was not participating in the price wars. Rivian demand for its vehicles were strong enough where it wasn't cutting prices. But now even Rivian is cutting their price. They've chopped off $3,100 off their base model and to make it more affordable. And now they used to start at $74,800. Now you can get it at $71,700, and the more expensive model used to be $79,800. Now you can get it at $76,700. So even Rivian, which previously didn't feel it needed to participate in the price cutting, is now entering into the price wars, signaling just how much demand is falling for electric vehicles. Now, you can see the impact this is having on the industry. The price wars started around late 2022, and you could see gross profit margins starting in late 2022 falling for Ford from around 14% down to 5.5% in the most recent quarter. For Tesla, gross profit margin falling from a height of around 29%, now down to 17.63% in its most recent quarter. And I wouldn't be surprised if in the next quarter, gross profit margin is lower for Ford and Tesla. Rivian is an interesting case because its gross profit margin is so severely negative at negative 35.68%. The company's improving its gross profit margin by selling more units, even if it's going to sell those units at lower cost, because it's utilizing a small fraction of its manufacturing capacity. It's been said that it has capacity to build about 150,000 units, and in 2023, it built less than 60,000 units, somewhere around 55,000 units. So it will increase its gross profit margin by increasing units sold, even if it's selling those units at a few $1,000s below where it was previously selling at. That's not the case for Tesla and Ford because they're at or about near their manufacturing capacity. And so if they're selling these cars at thousands of dollars below where they were selling them last year, that's going to hurt their gross profit margin because as we're seeing with Ford and Tesla, it's not really, these price cuts are not really increasing the units sold year over year. They're just slowing down the decrease in units sold in EVs year over year. If they weren't cutting prices, then sales of EVs would be falling even more. So what this means for investors is the valuation that you should be willing to pay should be lower, because you're investing in an industry that's amid a fierce price war and that's amid difficulties in consumer demand. So when I'm investing in an industry like that, first of all, I've been saying for a few years now that the car industry is one of my least favorite industries overall. And that was even before the price wars started. It's got very high capital expenses. It's risky. It's not very attractive from an investor's viewpoint like myself. I don't like these types of business models. And then now on top of that, it's facing fierce competition and rising price wars. It makes it even less attractive for me. So I personally would not invest in any of these car companies. And I haven't been really recommending any of these car companies, except for some of the really cheap ones. Like at moments, Ford and GM were so cheap, and you could see how cheap it is. Ford is trading at a forward price to sales of 0.273. It's only a fraction of the valuation if you think about it versus Tesla trading at a forward price to sales of 4.49. So Ford is less than one tenth, less than 1/15th the valuation of Tesla. So at some point when things were more attractive, I remember recommending Ford briefly as a buy, but even then I was lukewarm about it. But certainly I have not been recommending Tesla at these expensive valuations, and I have not been recommending Rivian at these expensive valuations. But now they're near the cheapest valuations they've been. So Tesla at 4.49 is near the cheapest it's been in the last year, and similar with Rivian, it's near the cheapest it's been. So now that the price has come down significantly, these investments are starting to look more attractive if the valuation falls more. So still, even at these lower valuations, like at a forward price to sales of 7.5, I would go nowhere near Tesla. But at a forward price to sales of 4.5, now I would start considering. I still wouldn't buy, but I would start considering. I would put it on my watch list. If there's another 10 to 20% drawdown, I would be more interested. Same thing with Rivian at forward price to sales of 1.462. I'm not buying, but it's, on my radar now. If it gets much cheaper, I will consider. Ford, again, I don't like car companies, but at this cheap valuation, I will consider. But things need to get really cheap for me, someone who does not like car companies, for me to invest. However, for the general investor that's interested in EV companies like Tesla and Rivian, it's not a good time, in my opinion, to get in right now. These price wars are intensifying and getting worse. Sales are falling. So I would still wait and observe what's going on. How is this industry going to shake out before I consider jumping in and buying these stocks on the dip? Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.